Let's do it, folks. The crowd is hyped up to go here on Wall Street as we officially bring about a close to the very first trading week of 2026. And why not throw in some all-time highs for the S&P 500, the Dow, the New York Stock Exchange Composite Index, and the small caps, all-time highs across the board. This crowd is fired up. The team from NCR Voyix here at the big board set to do the honors. Time now for the closing bell from the New York Stock Exchange. And with that, we officially end the first trading week here of 2026 with fresh all-time highs. And this crowd is fired up for the weekend. Come on, let's go. Join us now at the FinTech TV set, Joe Benaroche. He is the head of media partnerships, content, and distribution here at the New York Stock Exchange. Great to have you.
Well, thank you. You're an incredible part of our team.
And a very happy New Year to you as well. We are so excited to launch Taking Stock, our daily closing bell show here at the big board on Reach TV. Joe, from where you're situated, why was this the right time? And why is this the right partner?
Right time because the NYSE is continuing to scale all of its resources across our marketing, our media, our content, all of our distribution, everything that we're creating on behalf of all of our listed companies, all the tens of thousands of private companies that we work with. All of those media marketing resources continue to be a massive investment for us. And when we look at the last year, we have scaled partnerships almost 30 times more than we've had ever. We've increased all of our distribution by, tens to hundreds of million. And Reach TV is a natural part of that extension, considering where the business community ultimately rests. If you think about all of the travel, everywhere that they have all of their locked in already distribution network, Reach TV is a perfect extension. So if you put us on paper, we're automatic partners. As an extension of our wonderful partnership with FinTech, the things that we're doing with Money 2020, everything that we're doing with Cheddar, everything that you're involved in, it was a very natural fit to make sure that, the people that we are consistently trying to reach every day had access to all of the information that we're putting out in the marketplace.
Joe, when you take a look at the broader New York Stock Exchange community today, I wonder how different is the way that you're thinking about distribution, even compared to where we were this time last year?
Well, this time last year, it's a perfect way to look at it. This time last year, we had just launched what we called Partnership Day, or we were gearing up for Partnership Day in February. We were essentially opening ourselves up as an organization no different than any other media organization. So I have, a long history at NBC Universal, and those media organizations do what they call an upfront. And that upfront is basically to put out upfront into the marketplace all of the ways in which they can partner with you. Well, the New York Stock Exchange did exactly that. So from a year today, we have more creative partners, more content partners, more media partners that are coming not just to the floor, but that we're working with, more platform partners. We're looking at all of the new content creators. We have a wider distribution network. We have, I think we've increased the content that we've created almost by 100% year on year. We have, 1 million downloads to our podcasts alone. We have about 200 million reach on all of our distribution on the content that you're creating, that, Kristen Scholler and Ashley and team are creating. And why that's important is because the New York Stock Exchange views itself as a way to impart the information and narratives of all of those companies that I had mentioned earlier, all of those listed companies and all of those tens of thousands of private companies and all of the partners that we work with. So having that distribution is really important for us, but it all centers around the partnerships that we create, because we don't view ourselves as competitive to any other news network. That's not what we want to do. What we want to do is we want to be a partner to any content creator or any news or media organization.
This is an iconic institution. We draw our origins all the way back to 1792. The building, this iconic trading floor you and I are sitting on, this building opened up all the way back in 1902. But the audiences that we distribute our content to, the audiences are everywhere. How has the New York Stock Exchange continued to adapt that content strategy to actually meet people where they are?
That's a good question. And what I like is that you talked about our history. We are a 233-year-old organization. The New York Stock Exchange has rode and been a part of every single wave of technological innovation. From the from the telegraph to AI to every single platform that exists, from space to electronic vehicles. We have seen every wave of technology from 1792 to today. And so as part of that, we have platforms that are naturally part of the New York Stock Exchange, the fabric of our listed companies, and we work with every platform. We work with every single organization that is working to adapt AI within the fabric of their own company. And so for us, it's just very natural that what we're doing is working with every content creator or every platform. I'll give you an example of a platform, LinkedIn. While LinkedIn is a platform that has 1 billion people that they're connecting around the world, and they're connecting all of these businesses, they're also a publisher of news. So they will be right here on the floor, no different than the things that we're doing with X or the things that we might be doing with Snap, who's a part of our listed community.
Joe Benaroche, head of media partnerships, content, and distribution right here at the one and only New York Stock Exchange. Joe, thanks a lot.
Thanks, my friend.
Welcome back. I am Scarlett Sieber from Money 2020, and on this segment of Jargon Translator, we're going to make sense of terms that sound random, but they hit your wallet hard. Today's term, gas fees. Here's the deal. Gas fees are the transaction costs you pay to use a blockchain like Ethereum. Think of them like tolls on a highway. Every time you send crypto, buy an NFT, or interact with a smart contract, you pay a fee to keep the network running. But what's actually happening underneath the hood? Every transaction on Ethereum requires computational power. Miners or validators in proof of stake process your transaction and secure the network. Gas fees are basically the tip you pay to get your transaction prioritized. The more complex the transaction, the more gas it burns. A simple transfer, cheap. Deploying a smart contract, that's like ordering champagne service at a dive bar. That is gonna be pricey. So why are these gas fees so expensive? Because when traffic spikes, gas fees skyrocket. It's supply and demand at its simplest. More people using the network means higher costs. During NFT drops of meme or coin frenzies, gas fees can jump from a few bucks to hundreds of dollars. Here's the kicker. Gas fees aren't fixed. They fluctuate based on network congestion and the gas limit that you set. If you set it too low, your transaction might fail, but you still pay for the attempt anyways. That is brutal. Next time you're wondering why your $20 NFT cost $80 to mint, blame gas fees. They're the price of playing in the decentralized world. Until scaling solutions like Layer 2 or Ethereum upgrades fully kick in, gas fees are here to remind you decentralization isn't cheap, but it's part of the game. Gas fees, the ultimate reminder that even in crypto, freedom isn't exactly free. And with that, that is your jargon translated. Until next time.
If not for the sale of municipal bonds, the New York Stock Exchange would not exist. By 1790, the United States had incurred $80 million in debt. Alexander Hamilton, first Secretary of the Treasury, was called upon to draw up a report on the health of American economics, the result of which was the passing of the Funding Act of 1790. This act nationalized and consolidated the debt held by the states, only recently the 13 colonies, to be sold off in the form of American Treasury bonds. This is bond certificate number 3113, issued by the Treasury of the United States and dating from October 20th, 1791. It was purchased by Jacob Faitama of Amsterdam for $12,519.30 and pays an interest rate of 3% per year. Naturally, they were sold in a location that had been a marketplace since the days of Dutch New Amsterdam, the corner of Wall Street and Broad Street. This open-air bond resale marketplace was lively but unregulated and therefore easily manipulated. Two speculative brokers, Macomb and Dewar, nearly succeeded in cornering the bond market. However, they defaulted on their debts in 1792, which caused America's first financial crisis, the Panic of 1792, as well as the collapse of the bond resale marketplace. From the ruins of this collapsed marketplace, 24 brokers assembled beneath the shade of the famous buttonwood tree growing on Wall Street and penned the Buttonwood Agreement. Signed May 17, 1792, the Buttonwood Agreement is the New York Stock Exchange's founding document and lays out the rules for the development of a safe, organized, and trustworthy marketplace. 232 years later, we uphold those same principles. Since our origins trading American Treasury bonds, the exchange has continued to list and trade municipal bonds over the years, issued by cities, states, and the federal government. Listing your bond on the New York Stock Exchange ensured that it would get more visibility and gave municipalities access to capital that they would not have been able to raise otherwise. Here are some examples. This clipping shows an announcement in October 1869 by the Secretary of the New York Stock Exchange Committee on Securities, detailing which North Carolina state bonds were good delivery. These bonds were issued by the state of North Carolina on behalf of several railroad companies. Governments issuing bonds on behalf of companies that could improve their state infrastructure was common practice at the time. This clipping shows an announcement in July 1873 by the chairman of the New York Stock Exchange Committee on Securities that states Missouri Sixes, or university bonds, are to be added to the list, the sale of which benefited the state university. University of Missouri was the first public university west of the Mississippi, and they continue to educate pupils today. Liberty and other war bonds. Financing a war effort is no small feat. In April 1917, the United States entered the war on the side of the Allies and immediately needed to raise money. The New York Stock Exchange supported the war effort by sponsoring bond-buying drives and rallies for the war bonds known as Liberty Bonds, right on our iconic trading floor. This photograph illustrates one such drive, during which the New York Stock Exchange's famous Big Board acted as a makeshift billboard, encouraging members and employees to buy Liberty Bonds. The New York Stock Exchange also endorsed the purchase of war bonds after the United States entered World War II in 1941. Along with listing the bonds of municipalities around the United States, the New York Stock Exchange has also listed bonds issued by countries around the world. Foreign governments list their bonds on the New York Stock Exchange to leverage the status of the exchange as a nexus of global capital markets, raising capital for their own projects. Governments such as Portugal, Japan, and Austria have listed their bonds on the New York Stock Exchange, just to name a few. Here are some more examples. From the government of Jamaica, this is a 6 3/4%, $7.5 million external sinking fund loan bond issued by the government of Jamaica in 1981. From the Republic of the Philippines, this is a 6.5% 15-year external loan bond issued by the Republic of the Philippines in 1965. The Russian Imperial Bond. In 1902, the New York Stock Exchange listed a $1 billion Imperial Russian bond. That translates to about $27 billion today. As a thank you to the New York Stock Exchange for floating his bond, Tsar Nicholas II of the Romanov dynasty commissioned the House of Fabergé to make a gift. This Fabergé urn arrived in New York in 1904 and has been standing watch in our boardroom ever since. The New York Stock Exchange began as a marketplace for federal and municipal bonds, which the exchange continues to offer today. Bonds traded on the exchange have raised capital to aid in the construction of schools, hospitals, railroads, and other vital infrastructure for over 200 years. We believe municipal bonds represent investing in the most important capital any government holds, its people.
Let's do it, folks. Welcome back to the show. You're watching Taking Stock live from the trading floor of the New York Stock Exchange. Cooper Emmons joins me now, institutional lead of Injective. First time here on the show. Thanks for being here.
Thanks for having me.
Okay, so the crypto majors on the day selling off a bit. Bitcoin down 1, ETH down 1, 2, Solana down almost 3%. What are you seeing as you look at the general price action for the crypto giants?
Yeah, so we had a rough December, and I think into January we're seeing a huge look at what interest rates will do. And in addition, we're still seeing low leverage in the system since October 10th, and we'll kind of see how that plays out into the new year. I think if we see some positive developments out of the Fed, we could enter kind of a more bull market like period here as we get broader distribution through TradFi channels moving forward.
How do you view correlation for the crypto majors relative to the Fed or any other instruments in the financial markets? I feel like the narrative's shifted a lot, and people are always maybe trying to make connections that don't really usually exist.
100%. I think crypto really to this point is still a risk asset, and it's still maturing as we've seen the dollar kind of do a bunch of different things. So I think that they're very highly correlated as you see kind of the broader macro S&P and other equities and indices move in more of a positive lens. You'll see crypto continue to outperform those numbers as well.
Let's talk swaps. What are you seeing with regards to perpetuals becoming much more of dominant trading products? What do you track there you think our viewers should learn more about?
Yeah, so we've seen on-chain perpetuals kind of in 2025 garner more than $1 trillion a month in on-chain trading volumes across exchanges like Helix, Hyperliquid, and things like Lighter even more recently. And we think that that is kind of poised to grow even more significantly here into 2026 as we see the addition of new products. Things like US equities, things like Forex, et cetera, coming on chain and getting broader distribution into different markets, such as emerging markets, more globally, and democratizing access to some of those things through the crypto kind of product pipeline that has been built over the past decade.
What are you seeing with regards to tokenized equities? Gaining traction, losing speed? How are you viewing it for 2026?
Yeah, we saw a lot of headlines in 2025. I think 2026 will be the year that we see real user demand and growth. I think that'll be really fueled by perpetuals. We've seen perpetuals really be the product that has been really the driver for the majority of revenues for exchanges. And I think that really that's what users want. They want leverage, they want access to those products. So Spot's a great product, but I think that really what will propel US equities in the context of crypto and on-chain exchanges will be those perps and seeing how those things continue to evolve.
I'd assume you don't expect the general leverage space to decrease given the October 10th liquidation. And hey, leverage is great on the upside, but man, oh man, no one wants to catch that falling knife, Cooper.
That is correct. That is correct. I think that's why you see kind of borrowing rates being the lowest they've been in years. Leverage is totally wiped out, and we'll continue to take a look at that as the market evolves in 2026.
Any other big catalyst or things on your radar? A bit more of a risk-on rotation maybe for the new year?
Yeah, I think risk on from this perspective, kind of leverage has been wiped out, and really, it's just growth mode moving forward into the new year. And I think that there are, brighter days ahead for the broader crypto markets.
Yeah, we came into this week, and obviously one of the big news, not just in geopolitics, but more specifically here on Wall Street, impacting oil and energy and semiconductors and beyond, the military intervention in Venezuela. How are you viewing kind of the relationship between those events and the broader crypto landscape?
Yeah, I think we've built products for those types of high growth markets. And I think this will be a great opportunity for the cowboys of crypto to go into markets like Venezuela and see how these products like stablecoins, perpetual exchanges, and things like equities can really evolve and do well.
I got less than 30 seconds. Any big predictions maybe that you have for the broader space for 2026?
Yes, I think 24/7 price discovery for US equities will come on chain in 2026.
Wow.
I think that is really the largest opportunity for crypto to garner real liquidity, which will bring real usage and more users to on-chain products.
Yeah, we may have to change the time of the show. If that ends up happening. Cooper Emmons is institutional lead of Injective. My man, thanks for being here. Enjoy the NFL playoffs this weekend.
Thanks for having me.
Don't go anywhere. Much more Taking Stock coming up after this.
Appreciate it.
Welcome back to the show. You are watching Taking Stock live from the trading floor of the big board. Time for what is always my favorite part of the show, not just talking with an incredible guest, but a guest who just rang the closing bell. This is Jim Kelly. He is the CEO of NCR Voyix. Thanks a lot for being here on Taking Stock. Really good to have you.
Well, thank you very much. It was great to be here. It was great to ring the bell. I haven't done that in a long time.
Yeah, tell me about your experience of doing it, because I frequently get to interview, what a privilege it is, people who have done the bell.
Yeah.
They've usually done it for the first time. Not your case, Jim.
Well, actually, we just had sales kickoff for our organization. So there were 200 people that were here clapping very loudly we had a contest as well from people. It's a global company. So we had people from around the world through a contest, 13 of them, come up to the stage with me. And it was something. I mean, these are from as far away as Australia, Japan, Eastern Europe, Latin America, the US. It was great. It was very inclusive for the company, because it's not just about the leadership of the company or the sales organization. As they say, it takes a village to get stuff done. But relative to your question, I was the CFO of a company called Global Payments when it went public in 2001, February, rang the bell here. And then I took another company public in 2018 called Evo Payments. Unfortunately, that was on a different exchange.
Sure.
But yeah, coming here, and this place looks amazing. It really does. The boardroom, the electricity, as a result of my senior leadership in sales, to be able to witness, because they're also from around the world, for them to be able to share this moment, 100 years. There's only, I think, 35 companies that can say that they've been a public company for 100 years. So we're very proud to be in a rarefied air.
January 1926, NCR IPOs with an issue at the time, $55 million in stock. It was at the time the largest public offering in U.S. history. What are the core values that have stood the test of time here 10 decades later?
I think if you were to walk into our building in Atlanta, so we're right in the city of Atlanta, on the wall as you walk in, it's etched into this marble wall, treat every customer as if it's its only customer. And that was John Patterson's view, and I think that's carried through the decades and decades of CEOs, and it's embedded in the culture of the company. I think the company itself has gone through a split. We split from our ATM business a year ago, or a year and a half ago. Oops, sorry, 2.5 years ago. So the company's gone through a myriad of changes whenever you go through that kind of separation. But it was the best thing that could happen for the company, because today we're focused holistically on serving the retail and restaurant business. If you look at our customer base, you would know, of our top 400 customers, you would know every one of them. It's pretty amazing.
Okay, amazing.
Yeah, it is amazing.
So talk to me about the top priorities for the firm here as we roll over here into 2026.
Yeah, so we're moving from today, we move into a conference called NRF, National Retail Federation, which is at the Javits Center here in New York. It's one of the reasons we put all this stuff together. We're launching 10 brand new products. The company's never launched its own product before. So we've modernized the stack of technology. We've taken 50 applications and we've modernized them into 15 applications, 10 of which are going to be shown for the first time to all these valued customers. And really the customers have been looking for the modernization of this infrastructure that they've been working with. I think this industry's lagged to some extent, other industries, in terms of modernization. And for our customers to better know their customers, they need real-time data. They need to be able to innovate quickly. And when you're dealing with a monolithic application, the kind of the old way we used to write code, it just takes a very long time. It's very cumbersome. So we're excited. We actually had two of our largest customers, retail and restaurant, at the sales kickoff fireside chat today. So we had a chance to hear from them exactly what their needs are, as well as things that we as a company could do better.
That's amazing. I've got about 20 seconds, real quick, if you can. In the spirit of modernization, how do you separate signal from noise?
I think in the public market that's difficult. I think the way you separate is perform. I mean, you can hype all you want, but in the end you have to put numbers up on the board. So that's our focus for 26 and beyond, put numbers up on the board.
Well, welcome back, I should say,
you.
to the New York Stock Exchange. Great to have you. You don't need me to tell you, you're welcome back here anytime. You're an old veteran of doing the bell. It's great to have you here. All the best for the new year. Thank you for joining us. That is Jim Kelly, folks. He is the CEO of NCR Voyix. Wrapping up here, my friends, we've got 1 minute left here in the show, and I will get you quickly updated as I go through my sloppy notes. to let you know what to expect here on Wall Street. Next week, we've got a CPI inflation print crossing the wire on Tuesday. On Wednesday, wholesale inflation print in the form of PPI. And on Thursday, initial jobless claims, continuing jobless claims as well. Lots of Fed speakers, lots of earnings as well. On Tuesday, we'll hear from Delta. We'll also hear from Bank of New York Mellon, the original Bank of New York. Fun fact, the first publicly traded company in the history of the New York Stock Exchange, founded by the one and only Alexander Hamilton. We'll hear from JP Morgan Tuesday as well. On Wednesday, some of the other financial giants, Wells Fargo, Citigroup, and Bank of America. Will get a sense under the hood how the U.S. consumer is faring here in the first quarter of 2026. And on Thursday, Taiwan Semiconductor, the largest New York Stock Exchange listed company by market cap. We'll also hear from BlackRock and from Goldman, expecting earnings per share of $11.61. That's going to do it for us here at Taking Stock. Have a terrific weekend. Enjoy all of the NFL action. We'll see you again Monday.